Hi everyone, this is Yongyu Zhu, your real estate agent. Here is the recent market trends. Let's talk about this. Following a recent climb to nearly 7.5%, the latest daily monitoring reveals that mortgage rates have receded by approximately 10 basis points subsequent to the Federal Reserve Chairman's speech in Jackson Hole. During this speech, the chairman emphasized the committee's commitment to data-driven decisions and adaptable strategies in the upcoming months. Some observers inferred that these statements indicated a potential avoidance of another rate increase in September. In the aftermath, there has been a slight decrease in two-year Treasury rates, although the decline in 10-year notes has been more subdued. Consequently, the yield curve, a reliable indicator for impending recessions, remains inverted, suggesting the possibility of ongoing challenges in the coming year. Nevertheless, this situation also hints at the potential for rates to dip once again if the decline in 10-year rates aligns with the downward trend in shorter-term yields. As for other loans, the 15-year fixed-rate mortgage was 6.7%, down from 6.78% from last week. The 5/6 adjustable rate mortgage stood at 7.26%, down from 7.31% a week ago. The 30-year fixed-rate jumbo mortgage was 7.13%, down from 7.21% last week. While mortgage demand experienced its customary uptick in the spring homebuying season, the monthly new purchase applications index reached approximately 200 in May of this year, a decrease from the previous year's peak of around 300. This trend aligns with the volume of sales transactions, with California rebounding to slightly surpass half of the approximately 510,000 units it attained at the close of 2021. The influence of increasing interest rates has deterred certain potential buyers, as the combined impact of escalating prices has amplified the decline in purchasing power. The upward trajectory of U.S. single-family rent growth persisted, albeit at a more subdued rate. According to the most recent single-family rent index published by CoreLogic, the pace of rent growth has moderated for the 14th consecutive month in June, resulting in a year-over-year increase of 3.3%. This rise represents the lowest observed since autumn 2020. The monthly growth rate for June, standing at 1.1%, aligns with the pre-pandemic average of 1%, potentially suggesting a return to its long-term norm. Among the cities, Chicago saw the most substantial annual escalation in single-family rent growth at 6.6%, whereas Los Angeles, Long Beach, Glendale area experienced a 2.7% increase, and San Diego, Carlsbad recorded a 4.3% rise. As highlighted in previous editions of this report, new home sales have been steadily capturing a larger portion of the market due to the shortage of inventory hindering the growth of existing home transactions. Nationally, resale transactions declined to 4.1 million units on an annualized basis in the previous month, marking a 2.2% drop from June. Concurrently, new home sales experienced a 4.4% increase, elevating the proportion of new homes sold relative to the total single-family home market to nearly 16%. Builders have increasingly relied on incentives such as rate buy-downs and a comparatively less constrained supply of new home inventory to drive up sales levels and their share, while existing homeowners remain hesitant to part with their properties and the historically low interest rates they hold. Even in California, where there has been a slight rise in existing inventory for July, the ongoing unsold inventory index stands at 2.5 months of supply. This implies that, unless new inventory enters the market, California could potentially run out of homes to sell before the winter season arrives. Thanks for your watching this video. This is your real estate agent Yongyu. Please subscribe my channel if you like the contents. See you next time.